Ladies and gentlemen, imagine waking up one morning and discovering that one of the largest financial institutions on earth quietly admitted something that most people have been overlooking for years, not in a loud press conference, not on a flashing television headline, but inside an internal memo. A memo suggesting that one of the most historically important metals in human civilization may still be massively undervalued. When a financial giant like BlackRock studies markets at the deepest institutional level, their observations are rarely casual. They come from teams of analysts, data scientists, macroeconomists, and global strategists. And when something like silver appears repeatedly in that analysis, it raises an interesting question. What might the broader public be missing? Today we're exploring the idea suggested by the title that a quiet internal acknowledgement may reveal why silver continues to sit in a unique position within the global financial system. Not hype, not predictions, just a deeper look at the forces that shape markets, the psychology behind undervalued assets, and the long historical relationship between silver, industry, and wealth preservation. Across history, silver has never been just another commodity. For thousands of years it functioned as money, as a store of value, and as a critical industrial material. Ancient civilizations minted coins from it, nations built monetary systems around it, and even today silver remains embedded in modern technology, from electronics and solar panels to advanced medical applications. What makes the current conversation fascinating is that the modern financial system often treats silver very differently from how history treated it. Large asset managers such as BlackRock operate at a scale that requires constant evaluation of long-term structural trends. When institutions of that size analyze markets, they aren't simply looking at tomorrow's price movement. They are examining supply chains, industrial demand, geopolitical shifts, and monetary policy trends that could shape the next decade. When a metal with a long monetary history and growing industrial importance appears undervalued in that analysis, it naturally sparks curiosity. One reason silver frequently appears in discussions about undervaluation relates to something economists call perception lag. Markets don't always reprice assets immediately when underlying fundamentals change. Sometimes it takes years for a narrative to shift. Think about technology companies 20 years ago. Many people underestimated their impact because they were comparing them to older industries. Eventually, the world caught up with the new reality. Metals markets can behave similarly. The story investors believe today may not match the story the fundamentals are quietly writing beneath the surface. Consider the dual identity of silver. On one side, it behaves like a precious metal, historically linked to monetary systems and wealth preservation. On the other side, it behaves like an industrial metal with real-world demand for manufacturing and energy technology. This unusual combination creates a fascinating dynamic. When economic uncertainty rises, precious metals tend to attract attention. When technological expansion accelerates, industrial metals gain importance. Silver sits right at the intersection of these two forces. Think of it like a bridge between two worlds. One world is the financial system, currencies, central banks, and capital markets. The other world is the physical economy, factories, renewable energy infrastructure, and electronics manufacturing. When a resource touches both worlds simultaneously, its long-term value narrative can become far more complex than simple supply and demand charts might suggest. Another reason analysts often revisit silver's valuation has to do with scarcity trends. Unlike gold, a large portion of mined silver is consumed in industrial processes. Once used in electronics or medical equipment, much of that silver becomes difficult or uneconomical to recover. Over decades, this consumption quietly removes significant amounts of metal from accessible supply. Meanwhile, technological growth continues to increase demand for highly conductive materials, and silver remains one of the most efficient conductors known. Picture the global economy as a massive machine. Every year that machine requires certain materials to keep running: energy resources, rare earth elements, and conductive metals. If the machine grows larger, while the available supply of one component grows slowly, the balance eventually becomes interesting. Large institutions spend enormous resources studying these structural relationships because long-term imbalances often shape future narratives in markets. But there is another layer to this story that goes beyond supply and demand. It involves human psychology. Markets are not only numbers and charts, they are reflections of collective belief. Sometimes assets become fashionable. Sometimes they become ignored. When attention flows heavily toward one sector, other sectors can drift into the background even if their fundamentals remain strong. Think about the spotlight on a stage. Wherever the spotlight shines, that's where the audience looks. Yet the rest of the stage still exists, waiting in the shadows. Markets often behave the same way. When technology stocks dominate headlines, commodities may receive less attention. When cryptocurrencies capture imagination, traditional metals might seem quiet by comparison. But quiet doesn't necessarily mean unimportant. Large research teams inside institutions like BlackRock constantly scan the entire stage, not just the brightest spotlight. Their job is to notice when something significant sits in the shadows. When analysts discuss silver being undervalued, they're often referring to this gap between narrative and underlying fundamentals. Let's also consider the broader macroeconomic environment. The modern financial system operates within cycles of expansion, contraction, stimulus, and tightening. Central banks adjust interest rates, governments introduce fiscal policies, and global events reshape trade patterns. Throughout these cycles, certain assets react differently depending on their role in the system. Precious metals historically gain attention during periods of monetary uncertainty because they exist outside the direct control of any single government. Industrial metals gain attention when infrastructure, manufacturing, and energy projects expand. Silver's dual identity means it can participate in both conversations depending on the broader economic climate. Now imagine the perspective of an institutional analyst writing a memo. Their task isn't to predict a specific price tomorrow. Their job is to map structural forces. They ask questions like, how much silver is mined each year? How much is consumed in industry? How much remains accessible above ground? What technological sectors depend on it? How might energy transitions affect demand for conductive materials? When analysts combine these questions, patterns sometimes appear that challenge prevailing assumptions. This is where financial awareness becomes powerful for everyday observers. You don't need access to an institutional research department to think critically about markets. You simply need curiosity and a willingness to look beyond headlines. Instead of focusing solely on daily price movement, you can examine the bigger story behind any asset class. One useful mindset shift is learning to separate noise from signal. Market noise includes short-term speculation, sensational headlines, and emotional reactions. The signal often lies in long-term trends, structural supply changes, technological shifts, demographic patterns, and monetary policies. When people talk about undervaluation, they're often suggesting that the signal may not yet be fully reflected in the price narrative. Another helpful approach is studying historical cycles. Markets rarely move in straight lines forever. Over decades, sectors rotate between periods of enthusiasm and periods of neglect. Commodities have experienced multiple cycles where they spent years under the radar before suddenly returning to the spotlight when global conditions changed. Silver's long history makes it a fascinating case study for this kind of cycle analysis. From ancient coinage systems to modern electronics manufacturing, the metal has repeatedly found itself rediscovered in different eras for different reasons. Sometimes it was monetary demand, sometimes industrial expansion, sometimes geopolitical uncertainty. Each chapter added another layer to its story. What viewers can take away from this conversation is not a prediction, but a perspective. The real lesson is about awareness. Markets are complex ecosystems where narratives evolve slowly before they change quickly. By studying underlying fundamentals, supply dynamics, industrial usage, monetary history, you gain a deeper understanding of why certain assets attract institutional attention. Another practical insight is learning to think in time horizons. Short-term traders might focus on minutes or days. Long-term analysts often think in years or decades. Institutions like BlackRock operate on timescales that require looking far beyond the next market headline. Observing markets through a long-term lens can reveal patterns that short-term noise hides. And perhaps the most powerful mindset shift is understanding that value and attention are not always synchronized. Sometimes an asset becomes widely discussed only after its story has already begun unfolding. By the time headlines dominate social media, the deeper structural narrative may have been developing quietly for years. So what does all of this mean for viewers trying to understand the financial world? It means curiosity matters. It means studying fundamentals matters. It means questioning dominant narratives can lead to valuable insights. And it means recognizing that markets are ultimately reflections of human perception interacting with real-world resources. Silver's story, whether discussed in institutional memos or independent analysis, reminds us that some assets occupy unique positions in the global system. A metal that connects ancient monetary history with modern technological infrastructure naturally invites deeper examination. As we close, remember that the purpose of conversations like this isn't to tell anyone what to buy or predict specific outcomes. The purpose is awareness. Awareness of how large institutions analyze markets. Awareness of how narratives shape perception. And awareness that sometimes the most interesting stories in finance are the ones quietly developing beneath the surface. If discussions like this help you see markets from a broader perspective, consider sharing your thoughts below. Conversations build understanding. And if you enjoy deep dives into the forces shaping the global economy, whether it's metals, markets, or macro trends, make sure you subscribe and stay connected. Because sometimes the biggest signals in finance are the ones that appear long before the crowd notices them.